Hello everyone and welcome to Financial Accounting. Today we're going to talk about interest. Interest is a payment for the use of money. Interest can be calculated as simple or compound interest, where compound interest results in a higher return to the investor. Today we're going to compare simple interest and compound interest. The amount of interest involved in any financing transaction is a function of the following three variables: principal, the amount borrowed or invested; interest rate, a percentage of the outstanding principal; and time, the number of years or fractional portion of a year the principal is outstanding. The following three relationships apply. The larger the principal amount, the larger the dollar amount of interest. The higher the interest rate, the larger the dollar amount of interest. And finally, the longer the time period, the larger the dollar amount of interest. Simple interest is calculated based on the outstanding principal balance. It is the return on or growth of the principal for one time period. The following equation expresses simple interest. Interest equals P times I times N, where P is the principal, I is the rate of interest for a single period, and N is the number of periods. Let's look at the example from the video Time Value of Money, Future Value of a Single Sum. If you haven't had a chance to watch the video, I'm posting the link here and in the description to this video. Hyde Company recently signed a lease for a new office building for a lease period of 10 years. Under the lease agreement, a security deposit of $12,000 is made, with the deposit to be returned at the expiration of the lease, with the interest at 10% per year. In the future value of a single sum video, the interest was compounded yearly. Let's also look at a single interest scenario and compare the future values and interest earned under these two scenarios. Note that federal law requires the disclosure of interest rates on an annual basis, so the interest rate is always stated as an annual rate. If Hyde's deposit is $12,000 at 10%, the annual interest is computed as follows: $12,000, the principal, times 10%, the rate. The interest at the end of the first year is $1,200, and the balance at the end of the year will be $13,200. $1,200 interest plus $12,000, the principal. Do the same calculation for the second year. Note that we don't add interest from the first year to calculate the interest for the second year. The interest amount is the same for each year, and the total interest for 10 years is $12,000. The balance due back to Hyde at the end of the lease term is $12,000 principal and $12,000 interest. You can also use the formula and compute interest for 10 years. It is $12,000 principal multiplied by 10% and multiplied by 10 years. We just looked at simple interest, where interest is calculated on the amount of the principal only. Now let's compare that to compound interest. Compounding interest computes interest not only on the principal, but also on the interest earned to date on that principal, assuming the interest is left on deposit. This is the typical interest computation that is applied in business situations. This is the same computation we did in the future value of a single sum video. At the end of year one, the value of the deposit will be $13,200, which is $12,000 principal plus $1,200 interest. And at the end of year 2, the value will be $14,520, which is $13,200 plus $1,320 interest. Note that we just increased the year-end balance by adding interest. The balance becomes the principal balance for the next year's calculation. We can also use a future value of a single sum table for our calculation to make sure our numbers are correct. Just find the row for 10 years and the column for 10% to get the factor used in the calculation. Watch the video Future Value of a Single Sum for details on how to use the table. Using the factor from the table, the future value of $12,000 at 10% compounded yearly for 10 years is $12,000 multiplied by 2.5937 equals to $31,124. The compound tables rely on basic formulas. The formula to determine the future value factor is on the screen. You can use the formula shown on the screen to calculate the future value and the interest. You might want to pause here to take a closer look at the calculation if you haven't used this formula in the past. Note that the future value and the total interest for 10 years match our calculation on the previous slides. The number of periods represents the number of years times the number of compounding periods per year. The compounding period interest rate represents the annual rate divided by the number of compounding periods per year. If you're working on a problem that gives you the number of months or quarters, not years, make sure to increase the number of periods and decrease the interest rates. Watch the video Future Value of a Single Sum, where I explain it in detail. Now, let's look at simple and compound interest calculation results side by side. If you look at the interest for 10 years, the difference is significant. If simple interest is used, the total interest is $12,000. If compounding interest is used, the total interest is $19,125. The difference is $7,125. Increasing the accumulated year-end balance, which becomes the principal balance for the calculation, certainly helps to increase the interest for future years. Note that compound interest is the typical interest computation applied in a business situation. Simple interest usually only applies to short-term investments and debts that usually span 1 year or less. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button and ring the notification bell so you're notified when we release more videos like this. Visit my channel for more videos on financial and intermediate accounting. Thank you all so much for watching, and I hope to see you all again in the next video.